What we have discussed so far is why value creation is important. In the past, there were a lot of financial crises, and we observed that that was indicative that valuation fundamentals were not observed, and that is why those financial crises really happened. Then we introduced you three basic elements of valuation. First is return in the form of ROIC. The second is cost of capital in the form of weighted average cost of capital, and the third is growth. We'll discuss all three in these three topics in detail later on. Then we started with the discussion of various methods of valuation. The first one we introduced was absolute, then relative. In absolute, what you're really arriving at is a true value, or the intrinsic value. And in relative, what you're looking at is comparing it with peers versus the company. In this, we are basically looking at various ratios in order to arrive at whether it's undervalued or overvalued. You're pretty much not looking into what would be the stock price. As I introduced the formula of Microsoft there, you know the price was 28.09. Under the absolute method, what you will say is either the price is 35, or let's say 25, and accordingly you'll decide whether to sell or to buy in either of these two cases. But these will give you absolute number to look at, and compare it with 28.09, but with respect to PE or, enterprise value multiples, let's say beta or sales or anything of that sort under this, what you get is whether the stock is overvalued or undervalued. And you cannot really arrive at a particular number because the methodology is just to figure out whether a stock is overvalued or undervalued. We'll discuss relative models later on. First, we'll start with the absolute models. Absolute valuation model basically specifies the intrinsic value, or the true value we call it. What you're trying to do is, you're trying to figure out what should be the Microsoft stock price. In absolute numbers, it will not be whether it's undervalued or overvalued. It will primarily say, Microsoft stock price should be either 25 or 35, or whatever you arrive at, and accordingly you make a decision of buying or selling. So what you're basically trying to do here, you're applying the method of present value, that is whatever is happening in the future. Let's say these are future years. So what we are trying to do is you're basically looking into all these fundamentals going forward, and what you are arriving at is a number at today's price, which is the present value of this stock, which will happen in future. So there are different ways of arriving at these fundamentals. It can be in the form of dividend, or it can be in the form of cash flow. So in either way, what you're doing is you're looking at what is the profit, or what is the return to the shareholders, and the form of dividend or whatever is the available cash flow for the capital contributors in the company. So based on that, what we are doing is you have an array of information and you just discount it by a discount rate and you arrive at present value, and that is why this is an absolute number. We call it intrinsic value of that stock or the true value of that stock. And based on that, you say whether you need to buy or sell a stock. There are two basic methods. One is dividend discount model. The other one is discounted cash flow model. We start with dividend discount model. Once we have covered dividend discount model, you will basically understand the overall concept of present value discounting, and it will be easier for us to build on the free cash flow model after dividend discount model. And there is a very popular discounted free cash flow or discounted cash flow, which is DCF. DCF is one of the most prevalent model in the industry. Well, mostly on a daily basis, any equity researcher would be using DCF in order to value a company. Let's start with the dividend discount model, and then we'll move into the DCF part. Basically, dividend discount model is most suitable when a company is paying dividend. If a company is not paying dividend, you will not be able to really arrive at a true value of a company. The second thing is the dividend policy of a company has to really have a direct relationship with the company's profitability. So it cannot be that the company is incurring losses and still the company is paying dividends. That cannot happen. So what you need to look at, there has to be a stable history of a company and even the futuristic scenario of a company. There is a profitability and there is a direct relationship of dividend policy with the profitability of the company. The third scenario, or the third pointer in this is, investor takes a non-control perspective with this. What we really say is investor doesn't have any say on the policy of a company is a non-controlled view. So whatever dividend is paid to an investor, he or she takes that. There is no view whether the dividend should be less or more. You have to accept whatever is given by a company. So that is the non-control perspective. So basically where you should be applying this dividend discount model is it should be applicable to all the seasoned companies who are booking a lot of profits in the past. and why we're very stable operations, and that's the primary focus you should have when you're looking into a dividend discount model, and there should be a direct bearing of dividend policy with the company's profitability. Well, the formula used for dividend discount model for 1-period DDM is dividend in the next year and price upon sale in the next 1 year divided by 1 plus the rate of discount. 1-year dividend discount model, and apply it to an example. So in this question, what we have is we are given that there is by best shares they expect dividend at the end to be 1 point. The analyst expects the required rate to be 8%. The expected price at the end, that is P1, is 28. The current price is 26. So how do we calculate V0 is that his value is 1.25 plus 28 slash 1.08 raised to the power 1, since it has just 1 year. So we discounted by 1. So when we solve this, what we'll get is 27.08. So what we are trying to say is if the current price is 26 and what we are arriving at the intrinsic or the true value is 27, we expect this price to increase by at least 1. So we should basically buy this. And we say that this stock is undervalued. So as the question asks, determine whether the buy best is overvalued, undervalued, or properly valued. We call it undervalued, and we should buy it at this number being 25. Then it was undervalued, then it was overvalued, basically indicating that you should really sell this because you expect this 26 to go back 25, and that is why you lose out on 1 in case you were to retain the stock. So that is why we call it this to be an overvalued. Well, so far what we have done is we have looked into 1-year model. So now we get into multi-dividend discount model,